Hey traders, Jason here from Leavitt Brothers. Happy late Thanksgiving. Hope you're doing well. I'm going to do an update on my State of the Market series, see how things are going. Sometimes you just want to take a step back, look at the index charts, look at the breadth indicators, see what the trend is, see if the trend is supported. First quick announcement. We're running our Cyber Week special right now. Buy an annual subscription, get 3 months free. That comes out to just under $40 a month for all our research, all our trading ideas, access to our message board, which has a lot of really good traders, plus a lot of trading ideas thrown out there. So check it out at the link below this video. All right, let's go into my state of the market. I'm going to look at the indexes, and then I'm going to look at breadth just to get an idea of what's going on. All right, here is the global Dow chart. Okay, it is, as you can see from the little image up here, 42% of this is the US, and then it's broken up between other countries: 10% Japan, 8% Great Britain, France, 7% Germany, 5%. It rallied up. It traded in a range for almost 3 years. Obviously huge dip over here, but it recovered, and it just in the last month broke out to a new all-time high, and this month it is following through. This is really, really, really good. It's really bullish to get an uptrend. I mean, you can go back to 2012, uptrend, dip within an uptrend, flat period for 3 years, and then you get a breakout to an all-time high. Super bullish. Strength is not just in the US, it's all over the world. Here is the US monthly chart. This is the S&P 500 monthly. Support from the 50, support from the 50, not really there. This is bullish, okay? And each one of the big drops we got warnings from breadth, okay? This was the virus. There were some breadth warnings there, but that's mostly the virus. There was huge breadth divergences here and here, okay? The market is strong, it's healthy, it's trending up. Unless something like the virus hits, we're going to go up, okay? The market is strong, it's at a new high, okay? When the market goes up, takes 2 months off, and then goes up to a new high, okay? You can't be anything other than long right now. You can't be anything other than bullish. The market looks really, really good. Now let's look at some weekly charts. Here's the S&P weekly, okay? Rallied off the virus low, consolidated here while straddling the previous high, and then just in the last 4 weeks broke out to a new high. This is bullish. Here is the NASDAQ, just as bullish, maybe even more bullish. Kind of came down toward the weekly 200, tested the weekly 200 here, rally up to a new high, ascending triangle pattern. In the last 2 weeks, break out to a new high. This is super bullish. Here is the Russell 2000. Okay, rally up for about 3 years. Okay, you can draw, and then it traded in a range. I'm going to draw a trend line here. Then it traded in a range for about 2.5 years, and then just in the last 4 weeks, wrong pen. Just in the last 4 weeks, it broke out to a new high. Okay, this is bullish, super bullish. Okay, you get a rally for 3 years, a consolidation pattern for a couple of years, and then a breakout to a new high. That's bullish. If this was a stock, you'd be long and you'd be thinking, hey, I could ride this thing for 6 months, 12 months. I'm going to ride this up. This move here is probably more likely is closer to the beginning of the move than it is to the end of the move. This might just be the beginning. We could be trending up for a while. Could there be little dips along the way? Of course there are going to be dips. Could there be, after Biden takes office, maybe there's like a pullback? I don't know, maybe. But this is bullish. There's no conclusion that you could draw from this chart that is anything other than bullish. All right, let's go look at some indicators. Here is the S&P 500 versus the 10-day moving average of the NYSE AD line and the 50-day moving average of the NYSE AD line. Okay, when the market is healthy, the 10-day of the AD line tends to oscillate up and down, mostly above zero with an occasional dip below zero. Okay, so recently we had, that was the case over here. We had some good prints. Then we got into this area where it moved up and down, and so we got some dips below zero here. But now we're perched up here. We've been above zero for the last month, and we're at a pretty good level. Okay, so the index at a new high, percentage of stocks, or the 10-day moving average of the 80 line is at a pretty good level. Maybe there's the beginning of a divergence forming here, but divergences at a high level tend not to be too powerful. Okay, the most powerful ones are the ones that go down to zero. So here's a good example of that, where the second hump is closer to zero. Divergences where the second hump, third hump are at a high level are not as powerful. Okay, so this is in good shape. And then you look down at the 50 here, obviously really good shape. It's getting closer to its, a multi-year high here. Okay, for a while there it trended down, but like in the last few weeks, it broke out. Okay, so this fully supports the market. Market's trending up. 10-day 80 line doing well. 50-day 80 line doing well. Here's the cumulative of the 80 line. It's trending up. It's at a new high. What else can you say? There are no warnings here. The market is strong. It's healthy. Okay. You often get a divergence when the market's going to pull back, and with us at a new high here, we're not even at one high, let alone a second high. All right. NASDAQ versus the NASDAQ. This is the 10-day of the 80 volume line and the 50-day of the 80 volume line. Okay, similar to the 80 line with the NASDAQ with an NYSE that I just showed you. Steady prints above zero characterize an uptrend. Minor dips to zero, below zero are pretty normal. We had a dip below zero back at the end of October, and it's been up since. So we got a high print here, the highest print going back at least a year and a half. High print from the 50. So this fully supports the market. We got the NASDAQ at a new high, and we got the 10-day and 50-day 80 volume lines at a new high too. And here is the cumulative line. It's just been up. The 50-day moving average has done pretty well to support the stock, reject the stock, and just kind of support the stock all the way along. Even during these dips, this indicator told us like, hey, this is just a dip within an uptrend, not the beginning of a downtrend. So this fully supports the market. Next up, this is the S&P 500 versus the percentage of S&P stocks above their 20-day moving average, above their 50-day moving average, and above their 200-day moving average. Okay, so we want to know, there's 505 stocks in the S&P 500, and we want to know how many of those stocks are trading above each one of these moving averages. So at the S&P we have, or with the 20, we have like 77% of stocks are above their 20. We have 83% of stocks are above their 50, and we have 90% of stocks are above their 200. Okay, these are all solid prints. There's good participation, broad-based participation. There are no warnings here that the market is going up, but less and less stocks are participating. We have good, solid, broad-based participation. No warnings in place to be seen from here. Next up, we have S&P 500 up top. Here we have new highs at the NYSE and new highs at the NASDAQ, and then the blue line is a 10-day moving average. Okay, when the market's doing well, you tend to get just steady prints up and down, above zero. It's okay to get dips occasionally below, as long as there's a recovery. The problem happens when you get a dip below and then it stays at a low level. Okay, so we got each one of these dips below recovered, and right now we've been printing good levels above zero for the last month. The 10 days, here's the 10-day if it's hard to see, is in good shape. Spikes up. What we got here are a sign of strength. Okay, you want to see occasional spikes up. So, right here, again, everything looks good. New highs are printing. You can't argue that, hey, the market's moving up, but less and less stocks are participating because new highs are dropping. It's not the case. New highs are doing fairly well. So for those who say like, hey, it's just a couple of the big caps that are pulling the market up, it's not. We got pretty good broad-based strength here. All right, to sum up, the market is strong, it's healthy, it's trending up. The internals support the strength. And if left alone, the trend would continue, and my first S&P 500 target is 4,000. Okay. The bad is, positive virus cases are ramping up, but a vaccine seems to be coming. And then there's some question about a stimulus, like when does a lack of stimulus seep into the market? Okay. Despite the market doing well, there's a lot of people struggling out there. And will that seep into the market? Can it seep into the market? So far, it hasn't, obviously, because the market's doing really well. But we'll see. People are struggling and they need a little bit of boost. When there is a stimulus, I don't know if I would say that the market's going to immediately rally hard, because I think the market is assuming a stimulus is coming, so it's kind of priced in. So as of now, even though these are bad situations, the virus, the lack of stimulus, so far the market is doing a pretty good job absorbing the news. But if they don't improve, you'll wonder at what point in time a threshold will be crossed and the market actually does start to feel it. All right, so overall, biases to the long side. I am long with stops in place, period. How can we not be? Okay, where the index is breaking out to new highs and the internal supporting the strength, the long side is the only side to be on. From a technical standpoint, the market is in great shape. As long as the virus doesn't get out of control, which there's no guarantee, the market will do well. And when a stimulus comes out, another little backstop will be put in place. All right, thanks for listening. Quick reminder, our Cyber Week special is here. Buy an annual subscription, get 3 months free. It comes out to be less than $40 a month for all our research, all our trading ideas. There's a link below to our subscription page. You can sign up for an annual subscription, and I will manually add 3 extra months. All right, see you next time.